Welcome to The Prescription, the Tax Policy Center's biweekly webcast on fiscal policy. This is one of a series of conversations with state, local, and federal government officials, as well as leading economists and other experts. I'm your host, Howard Gleckman, a senior fellow at TPC and editor of our blog, TaxVox. My guest today is Arpit Gupta, assistant professor of finance at NYU's School Stern of Business. He has a BS in mathematics and economics from the University of Chicago and a PhD in finance and economics from Columbia's Business School. We'll be talking about his recent paper for the National Bureau of Economic Research on the effects of the pandemic on commercial real estate values and what that may mean for state and local finances. Before we begin, our usual bit of housekeeping. We encourage audience members to submit questions in the Q&A box at the bottom of your screen. The event is being recorded and will be posted online at TPC's website. We're using captioning, which you can adjust or turn off with the live transcript button at the bottom of your Zoom screen. If you'd like to join the conversation on social media, please use the hashtag #LiveAtUrban. And if you'd like to suggest a future guest for The Prescription, just email us at info@taxpolicycenter.org. Arpit Gupta, welcome to The Prescription.
Thanks so much for having me.
Great to see you. So you and your co-authors call your paper Work from Home and the Office Real Estate Apocalypse. Pretty dramatic title. You not only calculate the big decline in 2020 commercial real estate values as a result of the pandemic and the work from home trend, you project major declines going forward. So tell us a little bit about your conclusions.
Right. So we take our analysis in two steps. So the first thing we do is think about the broad shifts that have happened in office markets from a descriptive standpoint. We're looking at the total changes in leasing revenues, what's going on with rents, vacancy rates in different metropolitan areas, and what might be driving these shifts. The basic conclusion we get at just by looking at pure data is that it seems like there have been really big shifts in office markets. We're seeing huge increases in vacancy rates that are mostly being driven by firms who are not renewing existing leases. And we think these shifts are associated with remote work because it's the firms that are adopting remote work plans that seem to be demanding less space. So that's the first part of it, just looking at what's happening in office markets and thinking about what might be coming ahead. The second part is to understand these shifts from an asset pricing or valuation standpoint, where we want to take into account both the shifts that are happening from the cash flows for these buildings, because leasing revenue is going to be impaired potentially in a persistent way. And also what's happening with the risk, what's happening to the underlying riskiness of the cash flows, given this remote working situation is introducing new uncertainties into the economy. And so our approach uses an asset pricing framework to combine these shifts in cash flows, think about how persistent are the trends in working from home likely to be, taking into account those risks as well, and come up with a dollar figure for what we think is a fair value of office space, taking into account all those different considerations. And our key conclusion, adding up all those different parts, is that we think that office space is going to be worth about 40% less as of 2029. So kind of forecasting forward, we think there's going to be a persistent impairment in value resulting from these remote working shifts, with a lot of uncertainty around that, corresponding to the probability that we may go into a recession or an expansion or stay working from home for longer or not as long as we think.
And much of the study you did was New York, just to.
That's right. So we are focusing our analysis in New York, which is the largest office market in the country, but we also have some statistics that come from around the US. Our data provider for this analysis, CompStack, has information for about 105 markets all around the country. And so we do have a sense of how things are changing in different parts of the United States as well. It turns out actually that New York is experiencing a roughly representative decline in leasing revenue compared to the country as a whole.
I want to ask you about some of that variation in a few minutes. But let's start talking a little about the persistence issue. So few would disagree about the short-term effects of the pandemic on urban commercial real estate. But as your paper notes, office occupancy rebounded from a low of about 10%, nearly at the worst of it, to nearly 50% by mid-September. So do you believe low office occupancy is here to stay, and will this trend continue in the foreseeable future?
I think that's really the critical question. And I think everyone's trying to figure out what the long term is actually going to bring to us. Where we are right now, we can tell from data providers such as Castle, who are tracking the in-person office visits for workers, right? And what these data providers suggest is that in New York City, kind of around the rest of the country, you're seeing about half as many office workers physically come into the office compared to what they were doing before the pandemic. And this is actually a very different trend from what you'll see in any other part of economic life, right? Whether you're looking at airplane activity, how often people are going to movie theaters, all the other attributes of daily activity are really coming back if they have not already. And office really remains an outlier in that respect. It's really kind of flatlined the return to office statistics. So that's just kind of where we are. And of course, we need to think about where we're heading. The approach that we take in our paper is to try to get some of this information from capital markets. So specifically, we're looking at how the markets are pricing and valuing commercial office REITs, which are going to reflect the value of the subset of all office properties that are in their portfolios. So we think this is really more about the higher end part of the office market, what we can observe in public markets. And what we see there is a substantial value impairment for the publicly traded values of these types of office REITs. And so in our framework, we're able to map out the change in price to a market implied expectation for how persistent these shifts are going to be. And just based on the fact that there's been a lot of value decrease, that would suggest that there is going to be persistent shock to the market. But I totally agree that this is a parameter or value that's of considerable uncertainty and debate.
Another persistence question having to do with the business cycle, really. So surveys suggest that workers are much more supportive of working from home than their bosses are. If indeed we're heading for a recession and the labor markets soften, is it possible that workers will capitulate to employer requests that they return to the office and the apocalypse will look a little more like a passing thunderstorm?
I think there are two offsetting effects. So the first is what you mentioned, which is there's a role for labor market bargaining power. And firms can try to compel workers to come back in on that basis. Very recently, for example, Elon Musk is trying to tell all the Twitter employees, well, you better come back in. Right. And from the firm standpoint, if you're already trying to lower headcount, it may not be so bad if some of your workers are quitting because that's what you're trying to do anyway. Mm-hmm. But there's another part of that, and that has to do with the fact that office space is just very expensive. And so what we observe in our data going back several decades is even before remote working was around, recessions are bad times for commercial offices, right? Firms don't want to make these very large expenses when they're otherwise trying to tighten their belts. And so my guess is that second force is actually going to dominate, that rather than using this as a chance to really force workers back into the office, instead, managers and firms will use this opportunity to think, well, let's actually try to save a little bit of money because we're in a downturn, we're in tight economic situations, and that's actually a force that will push for more remote work. An example of this you can see is from Meta or Facebook, right? They're actually going to spend $3 billion in the coming years just to get out of leases that they're already in. That's the termination fee and expense that they're paying in order to reduce office expenses in the future.
What do you assume happens to this commercial space? Does it remain empty? Does it get repurposed? What happens?
That's a really important question for the future of cities. And I think it's a very open question. In some buildings, I think there is scope for conversion activity, but there is less scope of that than I had hoped for coming into this. It turns out that conversions in particular into multifamily residential space tend to be quite complicated for a variety of reasons that have to do with regulation and zoning, as well as just the fundamental difficulties of repurposing that kind of space. So there will be some of that activity, particularly in some of the older buildings. And we're seeing some of that in places like 55 Broad Street in the financial district of Manhattan. But I think right now, we're actually not seeing too much of that type of conversion activity. Then I think there's going to be a new mix of tenants and a new use of space for some of these office buildings. So there's going to be an impetus to try to upgrade the quality of the space, to try to attract other tenants to move into that space. So trying to attract new tenants, maybe people that were not traditionally in these marketplaces. And then I think there's going to be a mix of alternate uses. So those might be institutions like labs, which historically have not been as centrally located. They may be hospitals, they may be educational institutions, universities, schools. There may be different users of that kind of space. But I think for the foreseeable future, in the near and medium term, there just are severe issues. And one of the key issues that goes into that has to do with the staggered nature of leases, right? So we've seen dramatic shifts in the last couple of years, right? Cities like Manhattan are now at 30-year highs in terms of office vacancy rates. Places like San Francisco are also seeing really record highs in vacancies. And that's happened just in the space of a couple of years, with really only a fraction of firms having to make an active space decision because of the nature of these leases, right? Only some of the leases are coming due. In the coming years, there are going to be many more firms that are going to have those leases come due and are going to be making those active space decisions.
I wonder whether or not this transition that you're talking about, and particularly if we can find ways to repurpose this space, actually can make for healthier downtowns. You think about the problem of Midtown Manhattan, where after 6 o'clock at night, you have these massive buildings that are entirely empty. And if they were repurposed, could they actually create a more vibrant space?
I think the best example for that is, again, the financial district in Manhattan, because that's a district that used to be just an office-centric neighborhood. And it was the conversion of many of those older buildings into residential units that helped to spark a little bit of a revitalization. And it became more of a neighborhood that's about living as well as working. Mm-hmm. In New York City broadly, I think that the neighborhoods where people actually do live have remained much more vibrant compared to the neighborhoods that are predominantly there for commuters. But I think this requires a big shift in how cities approach their residents and their ultimate sources of revenue. So you can't have as much of a commuter-centric model where you're just kind of hoping for people to come in from other places and work in your office towers. You have to cater a little bit more to the residents that currently live in the city.
I think about this transition. The city that always comes to my mind is Pittsburgh. So, it evolved from a dying, polluted industrial steel town to a financially stable healthcare and tech hub. So, you wonder if there's a transformation like this that could happen in some cities. Hard to imagine quite so easily in Manhattan, but in other cities, could we see that kind of really dramatic secular transition from one economy to a very different economy?
I think that's certainly possible. And as of right now, it does seem like the sector that has done the best is this lab space. So in places like Cambridge, Massachusetts, for example, you see that there's just a ton of active space demand because that wet lab space really does need a lot of in-person physical activity, right? So I think you want to think about what are the uses of space that still are going to be really valuable, that people are going to want to come in for. Those are the kinds of activities that downtown centers probably should have a better mix of.
Mm-hmm. Another question about persistence. I wonder if rising energy prices and the need to address climate change could reverse the trend and actually restore demand for denser urban commercial development.
I think that effect goes a couple of different ways. So one thing that question raises is this idea that I'm going to relocate my location to be close to my point of work so that I can have a short commute and I can be in a dense location and I won't have to have as much of an energy footprint as if I was commuting every day from the suburbs. But another response to that could also be to stay in the suburbs and just drive to work less often, right? I think one of the things we were able to see over this last summer is people's returning to the office was very sensitive to energy prices, also weather conditions. So days that are unpleasant, days that it's raining, or days or weeks that have high energy prices tend to feature more people working at home rather than coming into the office. So those effects go in both ways, and I'm not sure what the net effect would be.
Yeah, a lot of uncertainty with a lot of this. I also wonder about the flip side of the trend that you identified. If people continue working from home, what does that mean for future residential housing valuations and for valuations in the suburbs?
Yeah, so this work I should have mentioned up front is joint with Steinman Neuberg and Brinda Mittal, and we have some other work that's together with UNS Peters that is looking at the residential side of things. And there we do find some evidence for increases in residential values further away from city centers relative to downtown areas, which is also very consistent with the idea that its dispersion in activity resulting from remote work is changing the geography of economic behavior and residential location. There's also other work from people like John Mondragon and Johannes Weiland, who argue that the level of overall real estate prices has gone up in the residential area because of increasing demand for home offices and more space at home. So I think there are broad shifts that are likely to happen across multiple different real estate markets.
And I guess the analysis for now is going to get confounded by rising interest rates, and it's going to make it very hard to figure out what's really going on.
Yeah, the rising interest rate environment is really hitting real estate hard, I think. And we haven't yet seen the implications, I think, on prices yet in many markets. But I think the trend is pretty clear that the rising rate environment is going to negatively impact the real estate sector overall.
So we're talking about residential, and I found an interesting article in the New York Times from December, so before the real explosion in interest rates. And what it said was that residential in New York was actually booming. And I'll just read you a quote. It said, more apartments were sold in Manhattan in the third quarter of 2021 than at any time in the last 32 years. Sales in Brooklyn and Queens pushed further into record territory, and some renters who took advantage of deep discounts just a year ago are now facing the sticker shock of 30 or 40% rate hikes. So talk to me about this phenomenon where commercial is taking this catastrophic hit and residential is still extremely strong.
The most natural way to understand those shifts in tandem, I think, is just the very basic idea that people are not as comfortable working in the office environment and would rather do so at home. But if they're working at home, they may need additional space to do so. And so that changes the relative demand for space at the office versus at home. Now, if you have a city government that spans both commercial and residential zones, maybe that's less of a concern because you have drops in value in some places and increases in value elsewhere. But I think the real reason this type of shift away from commercial to residential has been so damaging for many cities is because of the fragmented nature of urban governance, right? New York City is actually a little bit of an outlier here in terms of how large the boundaries of the city are. But in many cities around the country, you have a municipal boundary for the center of the city that might be relatively small right around the commercial business district. Mm-hmm. And so that's the center of the city that is experiencing large declines. It's coming from the fact that fewer people are commuting into the office, but that has a lot of spillovers and consequences on other economic activity. It means transit use is down a lot. It means people are less willing to spend on retail services in the proximity of those offices. And so that has big implications for retail activity. And even if that activity is simply transported to the suburbs or other residential neighborhoods that people live in, the governance structure may not span both areas. And so there may be winners and losers in this world and a complicated balance to try to keep everything together.
Yeah, I think as you're describing this, I'm thinking about a city like Boston, which is, I think, a dramatic example of what you just said. As you said at the beginning, your study primarily looks at New York, and the great cliche in real estate is location, location, location. And I want to talk to you a little bit about what you think this New York phenomenon means for the rest of the country. And I want to bring up a new paper. I don't know if you saw it. Tracy Haddon Lowe just did an interesting paper for Brookings where she looked at office vacancy rates in 10 metro areas. And what she found was in some, such as Chicago and here in Washington, D.C., she found the downtown vacancy rates were lower than the regional vacancy rates. She looked at MSAs. But in South Florida, she found the downtown vacancy rate was almost twice the metro areas. So what does this variation mean? What should I take away from this?
I'd have to look deeper into the study to diagnose that more, but I'd be interested to see if they had broken out the current levels of vacancies compared to the trends that we've been seeing before the pandemic in any case. Because one long-term trend you do see in many of these office markets is the suburban office often has higher vacancies anyway. So you see this, for example, in other Sunbelt markets as well. So they just sort of have high vacancy rates in general. And so they also have high vacancy rates now. There has been a change. Vacancy rates are higher, even in a lot of booming markets. But I think it's important to separate out the level and the trend. San Francisco is another example of this in the opposite direction. It had very low vacancy rates right before the pandemic. It was a red hot market. And now it has some of the highest vacancy rates in the country. But it's really the delta, the change that is quite dramatic in that location. So I think just a little challenging to separate out the long run and the very short run effects here.
Another interesting area to kind of pick apart is even in New York City, you identify that rents for newer high quality buildings with more amenities held up better than rents for older buildings. So what's that about, and what's that mean going forward?
Yeah, that finding really seems to be holding up in some of those major markets. So New York City, but also San Francisco and some other large metropolitan areas in the United States, whereby we're seeing that there is either a better holding up of value in some of the best buildings, or for some of the very newest buildings, their rents may even be increasing over the pandemic. And we think that is really about the idea that a lot of tenants are trying to actively incentivize and encourage their workers to come back to the office. And to do so, they really need high quality, high amenity office space in order to make that a compelling value proposition, because people have nice homes that they could otherwise work out of. We've learned that people are able to do that. And so if you want to try to get someone to come out of their nice suburban home into a dreary office experience, that's not a very compelling value proposition. And so this is encouraging many firms to upgrade the quality of their space in order to incentivize workers to come in, and increasing relative demand for that high quality space relative to low quality office space.
This sounds like something that you can do if the economy is really strong. Maybe it's harder to do if you're in a recession.
I think that's exactly right. So that flight to quality result is really kind of coming from the last couple of years of the pandemic, which have seen a high amount of remote work, and we think very interesting shifts in adoption of remote work. But at the same time, a lot of elevated stock prices and valuations for, in particular, tech companies, growth companies, who for a period of time were able to have the best of both worlds. They were able to offer very generous remote working packages. At the same time, they were buying up a lot of office space simultaneously. And that worked for a period of time, and maybe it's driving some of our flight to quality results. And I think it's sort of an open question to think about, well, what will really the long run implications be? Of course, we just talked about it may be that people are going to come back to the office. And again, our paper and our approach recognizes that. But it could also be that firms actually look at these large expenses and ask themselves whether that really makes sense in a world where they're really trying to lower costs. And our framework recognizes that as well, that we may have uncertainty about the persistence and duration and extent of remote work.
Mm-hmm. Okay, so we're the tax policy center. So I have to ask you, what do declines in property values like this mean for property tax revenues? What do they mean for local government?
So property tax systems in most parts of the US are somewhat staggered. So there is a slow moving appraisal process in order to recognize shifts in values into assessments. And so it's not necessarily something that's going to happen overnight for cities, but to the extent that there is going to be significant impairment in office values, I would expect that to be ultimately reflected in the property tax revenues that cities are able to get. And for a city like New York City gets about over half of its revenue from property taxes overall. Now that's including residential as well, which maybe helped a little bit, but a substantial component of that comes from taxes, property taxes on both office and retail space. Retail, of course, is very affected as well by these shifts coming from fewer commuters. So there are a lot of direct impacts there. Then there are the impacts on commuting we talked about. So traffic in the MTA, for example, here in New York is down pretty substantially, and the same is true in many cities around the country. And so that has direct financial implications for the functioning of those transit systems. So you're looking at a lot of different shocks to tax revenue. One more shock is the income tax implications for residents to the extent that they move out of the metropolitan area entirely and are no longer paying taxes to the local governments. So you have a lot of different channels by which the tax revenue might be hit. And I think there's an additional complication and wrinkle, which is how are local governments going to respond to the shift? Because if you respond to a decline in your MTA revenue by cutting back on MTA service, well, that makes it even less likely that people are going to want to come into the office, because they're going to just face longer wait times in order to get a subway car in the morning in the first place, right? So if you cut back on amenities, that's going to then impact other ways in which people experience the value of the city. We're also seeing this to an extent, I think, with crime rates. So the rise in crime is a complicated phenomenon, but I think it's possible one of the drivers has to do with the fact that there's fewer eyes on the street. There's less activity on the streets, and that tends to be an environment that breeds more crime. And if you have further cutbacks in government spending and services, that may worsen some of these provisions, like education, like on crime fighting strategies, which then may compel more people to leave. So I think there are a lot of important feedback loops that mean that how cities respond to these shifts also has large implications for the long run.
You described this as the fiscal doom loop, which is an interesting phrase, where as tax revenues go down, cities have less ability to provide services, which generates less interest in coming to the city, which generates less tax revenue, et cetera, et cetera. It's an interesting description. So under those circumstances, you talked about the importance of property taxes to New York and certainly other cities as well. What can cities do? Can they think about a different tax base? How do they respond to this phenomenon you described?
Certainly, and so this is outside the scope of the paper, but certainly I think trying to rely a little bit more heavily on some of the residential tax base, and in particular move to more Georgist land value tax systems might make sense. So again, that's going to refer to tax systems that are trying to not disincentivize or discourage new building, but instead tax the underlying value of the land that sits underneath. So that land is going to remain quite valuable no matter what happens with all these shifts. It's just a matter of whether that overall wealth can be taxed by the city government in a way that does not disincentivize or discourage people from engaging in relevant economic activities such as new construction. So I think, again, trying to shift the tax base so as to be a little bit more reliant maybe on the residential rather than the commercial side might make sense. I think trying to improve the quality of service provision would be ideal as well. Here in New York City, this is a very salient topic because when you walk around the streets, you see that so much of our street space is simply taken up by free parking, right, on the streets. And that is a vision of the city which saw everyone's going to be car owner, and well, we have to have lots of space for these commuters to come into the city. Where else are they going to park? And instead, if we think of the city as being more about the residents, then I think we want to maximize our use of space and think about the fact that, well, we've opened up that space for outdoor dining. And that's been a huge success. It's been part of the way that cities have adapted to the shock of the pandemic to really orient themselves more about consumption, more about experiences, rather than about production, which can, in any case, be done at home. And so trying to utilize that space more might mean more outdoor dining. It might mean more trash bins. So we can take the trash that currently is lying around all the sidewalks and put those in bins, or have more loading docks for deliveries that, again, are happening in many cases through e-commerce. So it's about kind of space utilization, better service provision, I think, trying to reform the tax base so as to not disincentivize or discourage the types of economic activity we're trying to most promote.
So this is also beyond the scope of the paper, but I'll ask you anyway. I wonder how this affects other taxes, such as income taxes. As you know, there's a growing legal dispute over where remote workers should pay their income tax. Do they pay it in the jurisdiction of their employer or in the location of their home office? So how does this phenomenon that you described affect that argument?
Yeah, I think this is going to be a long-standing legal dispute. I don't really know the specifics of the arguments and merits in either way. It does seem to me economically, it seems like a challenging notion to think that you're going to persistently tax people that just live in New Jersey and work in New Jersey, and somehow you're going to be able to tax them nonetheless. It seems like firms will find workarounds and different ways of addressing that situation, right? So I don't know exactly how that's going to pan out. You do see another aspect of this tax dispute is showing up in the congestion tax, right? Which New York City in particular is charging, which will predominantly apply to commuters that are coming into New York City from other areas. And so that's another example of a tax dispute that's happening because New Jersey also would like a cut of that tax revenue. So I don't necessarily have very well-formed thoughts on this topic, but I think it's a fascinating area and room for debate. Another aspect of this, I think, has to do with tax competition between different areas, right? So this is the TBO competition that people have talked about in the public finance literature, this idea that different jurisdictions are competing on the basis of the services and tax that they're collecting. And I think historically, there was a limit to how much TBO competition you could actually have, because at the end of the day, people typically just live around where they work, right? And so one city might have a great business climate, a great set of amenities, a great set of government services, but if they're not really able to attract corporate headquarters, then people are unlikely to move there in the first place. And so this meant that a lot of cities were really competing for those corporate headquarters and providing more and more incentives to do so, right? I think we were seeing a big shift in this since the pandemic. One way we're seeing a shift is that cities are much more inclined to try to have targeted incentives for people to move there rather than for firms. And then I think we're also seeing greater competition in terms of what the overall mix is that the city can offer in terms of tax collected, services provided, and so forth, and ways that mean that different cities are going to have to compete more aggressively on these margins.
Thank you. Well, we're out of time. Arpit Gupta, thank you so much. This is a fascinating paper, and certainly this is a phenomenon worth watching. So thanks very much to you, and thanks to our audience for joining us today.
Thanks so much for having me.